Hey everyone, Brian Bogner, Greg Towner here with Parallel Financial. And of course, it's time for our monthly update where we talk about, take the next few minutes, talk about the markets, talk about things that's on people's minds and stuff like that when it comes to this. So inflation is obviously a big deal right now. We're feeling it, we're talking about it. And so let's go ahead and dive into it. Greg, take it away.
Yeah, one of the things we usually like to do, Brian, is just take a step back and look at the broader view of the S&P 500, the stock market. We can see September, we had a very short-lived 5% correction. We hadn't had one of those in a while. It felt painful to people like, oh no, we haven't had a correction in a while. This is bad. And sentiment turned down quick. But now lo and behold, just like that, we're back to all-time highs, more or less, in the S&P and as well as in other markets as well. So brief little blip. So far, so good coming back from that. And part of the reason for that is we're now entering one of the strongest seasonal periods of the year. So depending where you are on this red line, looking forward 3 months from that point is your average expected return historically. Seasonally different times of the year tend to do well. Obviously, there's no guarantees. During that September period where we had that 5% correction, not coincidentally, it was the weakest seasonal period of the year. We're now entering one of the better 3 month seasonal periods of the year. So doesn't guarantee that the next 3 months will be great, but those so far things are starting to align with that already. All right, so right off the top, you mentioned inflation. A lot of people talking about inflation. We're now even hearing a lot of talk about stagflation. So let's do a little bit on this here. So what this chart looks at is the higher up that you are on this chart, more inflationary the environment. The further to the right that you are, the stronger the growth. So the red dots on this chart indicate where we are so far this year. We're in what is being called an inflationary boom. In other words, there's strong growth and strong inflation so far. Some of the economic numbers won't look good. The one GDP number that's about to come out won't look good because we had some down periods with the Delta COVID, but most economic data is really turning strong. We know the job market's strong. Where you get nervous is where you see a lot of those yellow dots in the top left. That was the 1970s, the classic stagflation area, meaning you had inflation, but little to no growth. Now, I mean, we can't predict what the months and quarters and even years ahead will be, but at least thus far, we're in an inflationary boom. So that's positive for business, and we'll take that compared to some alternatives for sure. And speaking of looking forward through the economic, I mean, we're in that inflationary boom, even though we're just now turning up on an economic surprise index. So of course, if we look at the huge spike up in 2020, economic numbers came in much better there for a bit than everybody expected. Expectations got too high. We had to kind of ratchet those back. We had the Delta COVID over the summer. But now expectations got so low here recently that the economic data is starting to come in better than expected. So I think people started to talk about stagflation right at the worst at that bottom point period. And now perhaps we're starting to look more positive on the economic side. And what are companies doing? Or what are companies saying? This number here is how good the surprises on the revenue, the sales side have been for companies so far here this year and in their quarterly earnings reports. We're at a record high for the business that companies are doing, the sales that they're seeing. So I'm sure they're having some of their struggles, supply, logistics. We hear a lot about that. Their inflation, their employment, all that. But the bottom line is they're selling as much as they can for the most part.
And along those lines, Greg, with this next chart here, even though there's been a lot of concerns about fuel prices and inflation and supply issues and things like that, one of the things we look at here is we take discretionary stocks, put them in the numerator, and staple stocks, meaning, like canned goods and toothpaste and stuff that, it doesn't matter what's going on in the economy, you're going to use those things, right? We put them in the denominator, and we chart a ratio of it. And basically, if this line's moving higher, discretionary items are outperforming, and if the line's going down, more stable, safer type stuff is outperforming. And right now, even with all of these concerns, people are not hunkering down and just buying their toothpaste and canned goods. They're spending it on discretionary items, which tend to do better when the economy is doing better. So even there, the consumer is still strong. So in summary, stock correction, that 5% correction's over, back at highs. We looked at seasonality. We don't need to get into why. We get asked all the time, well, why? Well, why did this happen? Well, why did that happen? Well, why did this happen? There's a million reasons why. But the reality is we're back to all-time highs now in the markets, and that is what it is. We're entering a strong seasonal period for stocks here at the end of the year. These October, November, December tend to be the best 3 months of the year for the stock market. Inflation does continue, but it continues with growth. Companies are beating their earnings. Discretionary is outperforming and proving the point here that energy costs are really, yes, we see the numbers at the gas pump, but they're not affecting the spending of the consumer. So as always, if you have any questions, you can give us a call here, 864-385-7999. You've got our email addresses here, but we want to thank you so much for listening today, and you have a good rest of your day. Thanks.